Arindam Ghosh, Chief Executive Officer with BlackRidge Capital Advisors, he joins us live. Arindam, good morning. Thank you for joining us. Arindam, on paper, it's very easy to make a bearish argument, but that bearish argument of late has not made money.
Well, morning, Nikunj. I think one needs to look at, I think, both the global as well as the domestic factors. Obviously, the global environment today looks a lot more benign, but the markets will clearly remain sensitive to the issue of the U.S. shutdown as well as on the issue of the U.S. debt ceiling. Now, our view is that while the probability of default is not really zero, but we need to be, and probably a resolution is the most likely outcome, but we need to be mindful of the risk. And as long as the standoff, between the Democrats and the Republicans continue, we will continue to see the rhetorics and the theatrics which will keep the markets on the edge. On the domestic front, I think clearly, we have seen a lot of, improvements starting to happening on the margin. So that is good news as far as the domestic market is concerned. But we need to also take into account the fact that the U.S., deals which have actually been drifting lower has actually been emerging market risk positive. Now, in a situation where a resolution happens, we may again see the tilt starting to kind of, favor developed markets, and that probably would see some more, sell-off or reversal of flows from the emerging markets back into the DM. So I think we need to be mindful of the risk, though we are in a relatively, benign environment. The good news is that the tapering, at least for the month of October, is off the table. So I think that comes in as a big relief. And the fact that domestically, we've been able to now stabilize our currency, we've been able to kind of, get a very strong and positive conviction from the policymakers that, the twin deficit is going to be contained. And, we have seen healthy inflows coming into on account of the FCNR issues. So overall, the situation, I think, is a lot more benign. But the good news is that the kind of excessive pessimism that we had seen in the past, I think that is getting gradually lifted. So, we may actually, kind of again slip into the trap of getting extremely pessimist if, some of the earnings downgrades tend to, again, get us into a sense that, growth is going to get extended, which is going to be the case, or the capex cycle is going to take a long time to recover. But we need to kind of also look at some of the improvements that have been actually happening at the margin.
Arindam, so what's the sense? Because soon we would have the earnings as well trickle in. Does it seem like the market, which is looking complacent / stable as of now, could get a little wobbly then?
Honestly, nobody is really expecting much from the earnings. So I think that kind of makes overall, environment a lot more easier. Obviously, there are going to be disappointments. There are going to be probably more downgrades than upgrades. It's going to be a mixed bag at the end of the day. But I think overall, I think within that, if you see clearly some of the export-led companies, will obviously find preference over domestic-led. We would also have, some of the companies probably, with who are going to be the beneficiaries of a good monsoon or, rural consumption, which is expected to pick up, or, which is already kind of showing an uptick. So there are pockets, I think, where we would see potential upgrades as well. So it's going to be a mixed bag. We need to keep a close watch on, of course, the banking sector, and that's the space, I think, where we would be a lot worried, and we'll be observing how the entire asset quality plays out, and that's where we are going to be more keenly focused, because for the markets to really sustain the kind of growth over a longer period of time, the banking sector has to kick in, and probably and therefore the importance of that is so much more, and therefore we would definitely look at that very, very closely.
But Arindam, do you not think that the asset quality concerns have persisted for a while to come, and maybe it's all in the price now? I would say that it's difficult to say that it's been entirely priced in, because we need to bear in mind that we've already entered a tight monetary regime. The effect of the interest rate hikes that we have seen comes in with
a couple of quarters lag. So obviously the impact of that on corporate profitability is an incremental impact is something that, going forward, we'll be able to kind of ascertain much more. And it's just not the NPL. We need to look at the stressed assets and how all of that actually gets managed. You need to bear in mind that, whilst probably the loan growth will get sustained, but there is clearly pressure on the NIM, and there are, in the PSU bank space, issues around capitalization and all of that, and the cost of funds have actually, gone up. I think it would be premature to say that, we've seen the worst. But having said that, I think if one has a longer term hold or an investment horizon, some of the banks definitely appear to be attractive given the levels at which they are currently in.
What is driving auto stocks? Tata Motors, Bajaj Auto, Hero MotoCorp, auto stocks of late have been marked outperformers. Now, auto often represents the true state of economy. It is a proxy to consumer demand. Consumer demand is slowing down, but there is a lot of underlying strength in auto stocks.
Nikunj, it will be kind of, not appropriate to, kind of paint it with a broad brush, because clearly there are, some outperformers within that space, and, that's where probably we are seeing volume growth, pick up in some of the overseas markets. But we remain bullish on some of the auto ancillaries space as well. Commercial vehicle space, again, is something that we believe, is going to continue to disappoint. Two-wheelers, again, I think, we have, some stocks which have actually been, running away. So it's kind of, I would say, overall positive bias, definitely, but, we need to be stock specific as well.
Arindam, what interests you from the metal space, or do you think these are just trading rallies that we've been, witnessing in the past?
Our sense is that this is more driven by, global factors than domestic. Obviously, from a domestic point of view, until and unless we see a clear pickup in the capex or, a revival of growth in any meaningful manner, I don't think this is something which is sustainable. A large part of this obviously is led by the fact that, on data which is coming in from China, and therefore that is kind of, boosting sentiments as far as metals are concerned. So I think one needs to kind of, watch it purely from, a short-term perspective till, a more longer-term, trend actually, starts to appear on the horizon.
Arindam, in last 6 months, we've seen a very polarized market, a very narrow market, and market participants, they have raised red flags about the narrowness of this market. But for those who've participated in these 15, 20, 25 stocks, they've made money. So what is the right way to approach this market? Stay put, even though these even though these 10, 15 stocks are expensive, they will remain expensive?
Historically, the investing behavior has always been, following some kind of a herd mentality. I think that's where, one needs to differentiate portfolios. It would also depend on the kind of calls, or one is actually taking, whether it's a pure short to medium term call or a little longer term call. Our sense is that, if we get into some kind of, a risk-off kind of an environment, we may actually see some of the cyclicals actually, starting to come back in favor. But, again, if we get into some kind of a risk-on environment, again, the tendency is to move across to some of these defensives. Obviously, the valuation is something which is clearly not, sustainable, and we are already seeing a weakening of the overall demand situation. Even for this quarter, we expect that, there would be, slowdown in revenue growth. We would see the margins to be sequentially, flat. The operating costs are already high. And contribution from Treasury also is going to be far more muted. So I would say that we would not really kind of expect a repeat of what we have seen in the past. But having said that, I think sectors like IT, telecom, they probably would still, see a lot of money moving in and rotational sector rotational happening in favor of these, clearly because overall demand environment both in US and Europe has substantially improved, and the benefit of the currency I think would continue for a little longer time. Obviously, we'll also have to see how the effect of the various wage hikes and all that play out. But overall, I think these are the two sectors where probably there would be a ready shelter, in case the market kind of gets into some kind of as I said, if the DM-EM trade again goes back in favor of DM, I think these are some of the sectors that would once again be the favorites to hide.
But IT has done rather well. Even though rupee has appreciated, US economic concerns or growth concerns, they still exist. IT on a relative basis is still leading the market rally.
Yeah, sure. I think that we believe probably is going to be is going to remain the trend, and I think the earnings probably will kind of confirm the overall consensus belief that IT is going to lead. But having said that, I think we need to be mindful of some of the risk which is there very much embedded in the system. Whilst overall, from an India perspective, we've seen improvement in the overall macros. But typically, many of the funds, are reluctant to increase or shift or adjust their portfolio, from underweight to a neutral or overweight position as far as India is concerned. India also, I think, runs the risk of actually being the beneficiary of a bulk of the FI flows which has actually come into this part of the world. So there is always this huge risk of reversal of money flow which can happen if, as I said, the US Treasury yield kind of goes back to the previous levels of 2.75 and beyond. And bear in mind that corporate performance in US is also going to be extremely strong. We expect some very good numbers coming out of US. So these are some of the triggers which can really spoil the party as far as India is concerned. Though it's good to see that definite signs of improvement are there as far as the economy is concerned.
Arindam, give me some names which have been part of your core portfolio and could remain part of your core portfolio for next 3 to 5 years.
Well, Nikunj, as we said, I think our preference is clearly on companies which have a higher export component and which is going to be benefiting out of the current, demand recovery that we are seeing in the developed markets, particularly Europe and US. And therefore, we remain kind of overweight those sectors. Also, again, some companies which obviously are consumption-led, but given the fact that we are now going more and more closer to the election, so we expect some of the rural spends to really support some of these consumer names. We like obviously some of the pharma companies. We like some auto companies as well. Overall, I think we also see deep value in some of the banks over a little longer term perspective. Clearly, the preference is to pick up quality balance sheets, quality management, and then kind of take longer term positions. Then really try to play the market in the short term, which continues to remain uncertain. Probably this DM-EM trade and also the risk on risk off environment is going to last till we see some kind of a certainty coming in as far as the Fed tapering is concerned, and then we may actually see the rally actually fading away from emerging markets. So I think one needs to be cautious. At the same time, I think one needs to be optimistic that probably things are now turning for the better. Though it's little early days, but clearly there are signs of some very early green shoots.
Arindam, so what's your sense? I mean, in the next 1 month, do you continue to see a range-bound market, and do you think the upside would be capped at, say, 59, 50 odd sort of levels, and we may be already sitting at a peak?
Well, markets have actually been ranged, for quite some time. We've seen, the markets kind of, at the top end, trying to break a certain level.
But the good news is probably ending with higher highs, so that's, I think, is one good trend. But in an environment where asset classes or asset prices have actually gone up because of artificial liquidity, our sense is that any kind of a news flow which can have an impact on the emerging markets, particularly countries like India, Indonesia, can actually spoil the party. So whilst the consensus is that probably the market is going to stay ranged, with probably 6,100 and 5,500 kind of levels, but we may actually see lower levels getting tested if any of these actually snap, or any of these moving parts actually goes against emerging markets, including India.